Here's something most people don't realize until it's too late to do something about it. Taxes don't stop during your retirement. For most retirees, especially those who saved well, taxes actually got worse. And it's not because that the rates changed, it's because the structure of the plan was never designed to manage them. Today, we're going to show you where the tax time bomb is hidden and what you can do before it goes off. So, welcome to Unlock Your Retirement. I'm Bruce Smith, the president and founder of WealthKare. And this is where our elite wealth planning begins, where traditional planning ends. And I'm with the man, Tony Shore. And that opener today, I'm sure you got something to say about that one, Tony.
Wow. Well, yeah. I mean, I don't want to, boom. I don't want a hidden tax time bomb. That's for sure. And that's what you're talking about here. Yeah. And by the time you realize that's happening, I mean, most people don't even realize, Bruce, that the accounts they have for retirement, almost all of them, whether it's a TSP, a 403B, 401k is the most common, all these employer sponsored plans, traditional IRAs, they're all tax deferred. So what they don't realize is, wow, I've saved up $1 million, $2 million in this account. So I've got that much money to spend in retirement. No, you don't, because at least 30% of that's going to be Uncle Sam's. That's a joint account, right?
Yeah. It's not it's and that's where the first wheels come off, is that people look at that amount, and even if they go to the next level, which is what you're talking about, and actually put a number to it and go, okay, I'm going to lose 30 or 40% of that. So in their mind, they go, okay, if I have $1 million and I'm going to lose 30%, so Uncle Sam's going to get $300,000 of my hard-earned money. But that's not the case. The fact is that, you were told you signed up for the deal. You said, "Hey, I'm, the financial guy, the 401k person, the home office person, and your all these people said, pay taxes later. You're going to be in a lower tax bracket. It's going to be wonderful, And the fact is, what does it really cost? We said last week on the show, we talked about a 1% drag in your portfolio on $1 million, and people thought, oh, that's $10,000 a year. You did some calculating, if you remember, and you said, oh, that's $300,000 over my lifetime. We go, yeah, but no, because you've now removed that money. It's not there to grow. It was almost $2 million. So the actual cost, I guess I'll call it sticker shock, of the tax time bomb is, what is it really going to cost all of us? What do I mean, all of us? People are like, wait a minute, it's my retirement account. What do you mean, all of us? Hold on. It's going to cost until the last dollar leaves that retirement account. There are taxes going to be paid by whoever is the overseer of that account. While you're alive, it's you. You take a withdrawal, it's taxable to you. But if you're gone, it becomes a tax problem for your spouse. And guess what? They are now single as a widow or widower. They're going to pay a higher tax rate. So more taxes come out. And then if money's left over when your spouse passes, it goes to your kids, who are probably in a higher tax bracket, or maybe still working, or it's
in their high earning years.
So Uncle Sam's, casting net gets bigger and bigger and bigger.
Yeah.
And that $300,000 mental cost for those that even do any math or taxes, they say, Uncle Sam's going to get $300,000. No, Uncle Sam, on $1 million account, we find that, in a normal retirement, about $1 million is what goes to Uncle Sam. This is why having a tax strategy that lets you plan for what that tax cost is going to be, and you can plan, you can significantly reduce that tax bill. So your spouse, your heirs can get what you plan for, or they're just going to get what's left over after Uncle Sam takes his share without planning.
Yeah. Yeah. And not good. And I'm glad you laid that out for our listeners and viewers, Bruce, because you really need to pay attention here. Most people completely overlook that. And even on the wealthier or the really good saver side, a lot of people don't realize that they have to plan ahead before they get to retirement to minimize that tax burden and how many different options and strategies there are. And the tax laws, the problem is Uncle Sam keeps moving the cheese. The old who moved my cheese, right? He's moving the cheese and he can change what percentage he gets at any time.
That's
So
exactly.
I don't even think he's my real uncle. He and Aunt Irma are not my favorite aunt and uncle. They're the mean ones. They're the ones you don't want to invite over or want to avoid at the family gathering because they just want a piece of you. And they have structured the IRS code to not be in your favor unless you know how to use it. They have things in there for your advantage. The IRS tax code includes things like Roths. They include things that are very HSAs, very equitable and advantageous, right? But most people don't utilize them properly or don't plan ahead for that.
Yeah, it comes with a rule book. Retirement has several rule books you got to refer to.
Sure.
There's the investing rule book, there's the income rule book, there's the legacy rule book, but we're talking about the tax rule book, and that's the tax code. And Uncle Sam, and all of his cronies say, "Look, here's the book. You read it, you interpret it, you find what fits you the best." Well, well, your retirement planning people, they'll help you, right? No, every statement you get says the same thing. It ought to say, "Hi, we are here and we deal with your investments. We don't deal with anything else." That should
Right.
be what it should say. There should be a warning label, right?
Yeah.
But they do give you a warning. They say, "We do not provide tax advice." But then
Right.
they provide a warning. The warning label is next. Seek professional guidance before making any transactions, because knowing your situation, exactly your situation, not your neighbors, not your coworkers, not your family, friends, or enemies, everybody, what's your situation? And now let's look at the tax code and say, where are the opportunities? The difference between a
Yeah.
wealthy person and the average person is the wealthy people are paying somebody to find those opportunities for their situation. I just saw a really crazy little video clip on Facebook, and the guy said, "Did you take a family vacation last year? I'll bet you did. And I'll bet it cost a lot of money, and it's not getting any cheaper for that." We talked about Disney last week,
Oof. Yeah.
you know? And what are you the one that said, Disney can best be defined as, how to spend $100 every 100 feet?
No, I didn't
That
say that. I wish I had because that's true. Yeah. Yeah.
that was somebody I it was one of my clients. They said, "You know how you describe Disney? It's the only way they developed you can spend $100 every 100 feet." And I went, "That's pretty good."
That is
You know?
really good and
Yeah.
unfortunately quite accurate in many
Yeah.
cases. I mean, but it's a once in a, it's an experience for a lot of people. It's many times a year people go, but it is a great experience. We're not trying to pick on Disney, but
Oh,
it
no,
is
no, no, I
costly.
loved
But
it.
the key is planning for it and knowing what you're planning for. It's like um, people don't people underestimate the cost of Disney and they underestimate the cost of taxes in retirement and they underestimate both. So not only are when we get to retirement we're taking all the grandkids, our kids and their kids, the grandkids, the significant others, we're going to take them all to Disney World and we don't have to worry about taxes. Well, those are two of the biggest myths that people have. I've seen people just blindsided by both of those numbers. So
Yeah, and
right.
and we're talking about, we say about the tax time bomb. The fact of the matter is that and we've said this many times on the show in the past. It's kind of like walking up to a new car, and you're going, "Yeah, it's my color, it's my interior. Oh, I love it. I love the accessories. I love the wheels. Oh, this thing is awesome." And you look at the guy and say, "How much is it?" And he says, "Oh, it's the payments are fine. Let me get the paperwork." And "Well, how much is it?" And no, you don't know. There's no window sticker.
Right.
How much is it? Give me the price tag, and you don't have it. So when they say about, seek professional guidance before making transactions, is what does the tax code say, and what is the best way to pay off that debt that you've accumulated, and that's what it is, to Uncle Sam. And we just came out of tax season. Finally, okay, I can get a rest. But
Yeah.
the thing is, you say, "Oh, I paid my taxes," and everything tax centric in our life is about what can you do about saving me taxes this year. Everybody wants to get a bigger refund, or if people are paying in, because they're doing quarterlies or whatever, I want to pay less in. I want to pay less in. I want to get more back. But they're looking, through pinholes, and that's all they can see is this year. What if you had an opportunity to sit down with somebody and say, okay, let's look at all of the years. Let's not do a one-time plan. Let's look at a lifetime plan. Let's look at what the price tag is. Let's start with that. And that's where it should begin is, for your situation, nobody wants to hear this. Nobody likes this conversation, but it's a necessary conversation because
Yeah.
it's reality.
Right.
How much is it gonna cost you in taxes over your lifetime? And that's where all of a sudden the box lid got popped open, and it wasn't a puzzle box lid. The puzzle bo the box you got me on puzzles now. See how you are?
I know. You're the box lid, right? Yeah.
Ugh. So you open the lid, and all of a sudden you look in, and it's kinda like an NCIS, show, all of a sudden they open the box, and what's in the box? There's a bomb, and it's going
Yeah.
tick, 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 and the timer's counting down. You're like, now
Yikes.
what do I
Yeah.
do?" So, how do you disarm the bomb? How do you find the path to get you out of that? And that's one of the cornerstones, and I think probably one of the most unique qualities about the elite wealth planning we do at WealthCare is I mean, if you go to our website, our main website, wealthcare.com, wealthcare with a K, you will see, and we made a little modification this week we're going to talk about to the website. Pretty cool. But it says right here, finally, someone who has a strategy for my retirement taxes. So I have to. We had a kind of a crazy thing happen this week. A good friend of mine in California was doing a webinar, and unbeknownst to me, he invites me to the webinar. Okay,
Okay.
and he's a guy that helped engineer the new whywealthcare.com
Oh,
site
wow.
and the
Okay.
askwealthcare.com site, the two
Yeah.
video insights sites that
Great,
we've
great websites, by the way.
and
Whywealthcare.com. That's wealthcare with a K.
with a K, yep. So it turns out he made my main website, WealthCare, the subject of his webinar, and I went, "Okay, this ought to be good." And he's like, "Now, if this was my website, here's what I would do differently." And I mean, I don't even know this is coming, right?
Oh my
And
gosh.
the guy's like,
Really?
"I would do this, I would do that." And I love the guy to death, and I wanted to kill him. I'm like,
Well,
"What
sure.
are you doing?"
Yeah.
And but at the end of the day, he
Oh
was he
no.
was right. So, we've made a
Mhm.
modification to wealthcare.com. Oh, I love your cup today. Ladies and gentlemen, show us that cup.
Oh, you like my
I
cup?
wore an iridescent belt buckle with that logo on it for my last few years in high school and all through
Oh yeah.
college.
Yeah, my
That
favorite band. Yes.
Did you see
Yeah.
their new release?
Yeah. Yeah.
Did you see the video from the first, song they released?
I saw it. Oh
Pretty
yeah, they're my
wild, wasn't it?
favorite band, and yeah, it's really good. Not the original lead singer, not John Anderson, but it's still really
Right.
good, and the music was fantastic.
I thought
Can't
the
believe
music
they're
was
still doing
fantastic.
it. Yeah, Steve Howe, the original guitar, or one of the original guitar players, is in it. He's their second guitarist, but pretty much the Yes sound. But he is not a young man.
He is
Uh,
not aged well.
he-
Steve
and
looks
he,
pretty rough,
he
but
looks
he's
rough. He looks a little like Gollum from the Lord of the Rings
he
movies, but
does. He
poor guy.
he does, you're
I've
right.
met him I met him a few times. I'm actually friends with Rick Wakeman and John Anderson, the keyboard player, the original keyboard player, and
Yes.
well, the main keyboard player, not original, but Rick Wakeman, and then John Anderson, the lead singer. But there's a new John
Talking
singing
about the
now, I
group,
believe.
yes,
Yeah, we got off track. Don't get me started on Yes. Yeah, I made the mistake of showing the mug, and then you're going to get me on my favorite topic of all time, which is Yes. But a more cost important topic for our listeners and viewers is what you're talking about. So you ended up making the changes to the website. I would have
so
loved to have been a fly on the wall and saw your face when he showed your website and said, "Here's what I would do differently."
Well, I mean, you probably have your computer in front of you there. Go to it. Go to wealthcarewithak.com,
Yep.
and you'll see it. So his suggestion, he's like, if I had the askwealthcare.com and why wealth, and the reason for those sites, why wealthcare is really a great little video snippets of why you'd want to consider working with us. So it's great insight to the firm. And then Ask Wealthcare is kind of the 20 top retirement questions that people have. So we modified the site on the main page there. If you look at the very top, it says why choose us and what we do to help people. But there's like a red box around it, and it says new prospective clients start here. So we actually control your journey, but right there at the top. So if you can't remember the ask or why wealthcare, just go to wealthcare, KARE.com. And right at the top, you'll see the little red brackets at the top there, and they'll take you to these other two pages. So we've made a loop, if you will. His suggestion, and I thought, oh, he's right. So we made the modification, got it put in place. And, and I called him and threatened him with a lawsuit. And I joked, no, I'm just kidding. I told him, I said, man, oh, you're right. It was a great idea. So we made the modification.
Right.
Do you see it there? You see it?
Yep. Hang on a second. I'm actually going to be able to, I believe, share it with everyone. Let's do
Whoa,
this.
ladies and gentlemen, welcome to technology. Wow.
All right. Until it is quit later. It might make me quit I might not be able to, but
we don't want to lose you there. So
yeah,
I need to get on the air. I can get an on the air screensaver for my big screen behind me here. So
yeah. Well, I should be able to share screen. Select a tab to share. Why clients use us. There we go. Let's see.
Oh, look at this, ladies and gentlemen.
Yeah, there it is. And then I think if I scroll down.
No, you have to go back to the WealthKare itself, wealthcare.com.
Okay.
Here's something worth thinking about.
I like that. Let's go to wealthkare.com, right? That's what we're talking about. Yep. WealthKare with a K.
Okay.
Yep.
Okay. So, right up there in the right corner.
Yep.
So we've added to our site. We now have prospective clients start here, why clients choose us, and how we help our clients.
Let's go to how we help our clients.
Yep, it'll take you to our two new pages.
Yep. And look at that. Look at you in front of a swimming pool.
Yes.
What would have been funny at the end of this video is if so Bruce is going to talk to us here, and you're going to question that sounds
simple.
If then at the very end I run up and push you in,
can we actually retire?
You think
on paper? Thanks a lot, Tony. Wow.
It'd be funny to see you in a swimming pool in your suit. I bet our viewers would like to see that too. But more important for our viewers,
I think if he went to the fair and I was in one of those dunk booths, I think Tony would drop $100 to throw balls at.
You know what? If you were in a dunk tank, it would probably take me $100 to hit that little round target. That's how bad of a name I am.
Go to the bottom of that. Go to the bottom of that page. We don't do this enough. So
what's this?
All the way down.
Yep.
So I gotta give a shout out to these guys. So the good looking guy in the blue, that's me. But
the best, the looks, the eye candy is you. Who's the brains?
This is that's my son, Bruce the Fourth.
In the middle.
If you're watching this on YouTube, if you're watching this on radio, quit staring at the dial and going, I don't see them. What's going on?
Which one of these is your son for our viewers?
The one without the beard.
Yeah,
the one in the brown jacket.
The brown jacket is your son, obviously. You can see the resemblance, and that's Chris in the center. Yeah,
and that's Chris, and Chris has been coming around my house since 4th grade, so he's about as close to a son as it gets. But I'll tell you right now, Chris is our on-staff CFP, and I got to tell you something. I mean, these guys, and I don't say that because they're my partners. I don't say this because of relations. The fact is, I will put them up against 95% of the people in this business. These guys really know their stuff. And one thing we did from the very foundation of WealthKare in 1996 is I said, we're going to build this in a way that it's a team approach. So if you're a client of ours, you're a client of WealthKare. So if you have those tax questions, if you have those legacy questions, income planning questions, risk management, specific planning to significantly reduce your risk exposure, yet still keep that opportunity for growth, you can talk to any one of us, and we all have access to the same information, the same data. They can
Right.
pretty much finish my sentences, so they've earned it.
Yeah.
And people like that, and it's something unique is, I'm not going anywhere. I'm planning on hanging around, Lord willing. But if I step out of the picture for some reason, planned or unplanned down the road,
Hmm.
you've got the next team is already in place and they've been there 20 plus years. So
Yeah.
I just want to share that with people, and this is great. This is
Yeah.
I
Yeah, and
didn't
all these videos, I've watched these videos. They're fantastic and they're very helpful. I would encourage, and they're under 2 minutes. So
yeah, they're all under
I would,
2 minutes.
yeah, they're all under 2 minutes. So I would really encourage our listeners to go there. And all you have to do is you can go to askwealthcare.com or whywealthcare.com, or just, and that's all. WealthCare is always spelled with a K,
Yep.
Kare at the end. But whywealthcare.com or askwealthcare.com, or you can just go to wealthcare.com
And look for the
and
little red brackets up in the corner, and it'll take you to
yep,
both pages. So you can
yeah,
consume as much content, learn as much as you want about us, and
yeah,
I think you'll kinda get a feel, and then the end result is, if any of these things, if this show, if another YouTube video you've watched or whatever resonates with you, all you do is go to the Why Wealth Care or the Ask Wealth Care, and at the bottom, click and request a 20-minute retirement discovery call. And that's an opportunity for us to talk with you. And I will tell you, it's a structured call. It's not a BS session. It's not a sales pitch. It's not pressure. We actually have a short 4-question questionnaire that we will send you. 4 questions, multiple choice, A, B, C, D, and that will let us generate your personal retirement value control panel. That lets us show you how efficient, based on your input, your retirement is, and where there may be room for opportunities. And that 20-minute discovery call gives you that opportunity of what is the next best thing you should be looking at to strengthen, to make more durable, to maybe increase long-term performance from your retirement planning. And that's whether you institute it with yourself, your another advisor, or with us. So it's a very important 20-minute call, but it lets us understand your situation, and it lets us be objective, because we just had a gentleman actually reached out to us from the show last week. Um, he's interested in doing an in-depth tax plan, and it's like, I'd love you to develop a tax plan, and the thing is, everything is connected. We do coordinated planning. So I mean, you're as much as I would love to just say, "Oh, we'll crank out a tax plan for you," it's not something that really fits, because it's going to affect your legacy. It's going to affect your income is going to affect it's going to affect the taxes. Your risk is going to affect the taxes. It's all going to affect legacy. Legacy impacts other things. So if you want to know what you're planning to achieve, then it has to be across the board. And that's what coordinated planning is. So as we look at you, that's where we're looking for opportunities, because everybody we work with, it's a total coordinated plan. It's not an individual tax plan or investment plan or income plan.
yep. And that's why everyone needs a plan. They can go to wealthcare.com. They can go to whywealthcare.com or askwealthcare.com and watch the videos, schedule your appointment. Before we go, we're going to come right back with more on this topic, talking about that hidden tax time bomb. But Bruce, thank you for that. Listeners, again, call 888-888-5601 or go to whywealthcare.com, and that's care with a K. All right, you are listening to Unlock Your Retirement. I'm your co-host, Tony Shore, and I'm excited to be here with our host, the host with the most, Bruce Smith the third. And Bruce, for our listeners on radio or podcast channels like Spotify or Apple Podcasts, Amazon Music, we were talking about some visuals in your website. If they want to see that, or if for some crazy reason they want to view us and watch us do this show, go to the YouTube channel. Go to YouTube and type in Bruce Smith and Wealth Care, care with a K. and you'll get the channel, and you'll be able to watch all these videos. You'll be able to see us go through his website and show you what's on there. We did that at the end of the last segment. Now we're moving on, and when it comes to taxes, it's tax season. Most people live for the now, and it's too hard, Bruce. What if I don't want to give up my tax deductions for this year? So I'm used to putting all this money into a 401k or a traditional IRA, and it's all tax deferred. So none of that income that I've earned that I put into my 401k hits my taxable income. But I know you're saying that also leads to this hidden tax bomb later in retirement. When that account is bigger, I'm going to pay taxes on more money than I would now. It's going to cost me more. The thinking used to be it doesn't matter because you'll be in a lower tax bracket in retirement, but that's just not true. So what do? I've got to give up a little now then to get a lot more later. Is that what you're telling us we have to do?
Well, this one, you'll appreciate this one. I don't think we've ever done this on the show with you. I've used it in the show because I've been doing the show for 20 plus years. But
Yeah.
God, where did that go?
Yeah.
But
Whoosh.
so this is how I explain it to people, and I'd say 90% of them get this. So
Mhm.
I want you to picture a farmer in his pickup truck. Of course, nowadays they're $100,000 pickup trucks, which still blows my
Sure.
mind.
Yeah.
Poor farmers, right? But no, I love farmers, and I know you do.
Yeah.
So he goes down to the feed mill to get seed for this year's corn, and he gets several bushel of seed corn, and they said, okay, that's going to be $472 plus tax. And he goes, no, 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 I'm a farmer, I don't pay tax. And the guy at the feed mill says, oh, no problem, you're right, yep, we'll just get you at harvest time. And you load the seed corn on, you go to the farm, you put it in your planter with your fertilizer and your anti-weed, everything great. You go out and plant it. And my thing was always corn. I love planting corn.
Sure.
I could hear corn grow. I loved
Yeah.
corn.
Yep.
So then you go out and then it's harvest time. Out comes the combine, out comes the trucks, and we're rolling through the fields and we're harvesting the corn and it's going in the trucks and it goes out and you go out and all of a sudden they have, here's your net check for your corn after taxes on all that corn. And they go, whoa, 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 what are you talking about? And it's like, hold on. When you picked up that seed corn in the spring, we told you pay the tax on it. You said, no, I'm a farmer. And we said, we'll see you at harvest. So for every bushel of seed corn you planted, now you've got 30 bushel, 40 bushel, 50 bushel if you're a super corn farmer, and you're going to pay tax on all of that. So do you want to pay tax on the seed or pay tax on the harvest?
On
And that's
on the seed every time because
what
it's
people
smaller.
don't, but no, but we didn't have that. I mean, I've been doing this
Right.
40 years. We didn't have that for 25 of the last 40 years. The first 25, we didn't have options. It was basically, this is how it's going to be. When the
Mhm.
Roth came into existence, even then, it still wasn't a great planning tool. But then
Right.
what people don't realize, and this is always the wide eye moment as we're talking with people that have saved $1 million, $1.5 million, $2 million, $3 million in their combined 401ks and retirement plans at work and IRAs and everything. They're like, "Well, I can't contribute to a Roth." You go, "That's fine. I know that." But they changed the law, and the law says this now. So in today's world, in today's tax world, you can convert as much money, unlimited, as
Hmm.
much money as you want, any time that you want, at any age that you want. I mean, it's Johnny bar the door. There are no restrictions. And why did the government do this? Because guess what? Wealthy people want to take advantage of it. Politicians want to take advantage of it.
The
They know.
politicians that voted that law and want to take advantage of it.
Yeah, so I mean, what started that, the Roth was designed by Congressman Roth as a way to help poor people put money away for retirement and not have the heavy tax bite, and it was a great, very noble effort. Of course,
Yeah,
once
that's
again,
true.
politicians went, "Oh, hey, we got some great ideas here," and never do my hands leave my wrists, right? And
Right.
and in the middle of the night, they made this rule, So it's like it's the greatest planning opportunity ever. It's like you're going to have this big tax bill. You got this tax time bomb out there. How can you diffuse it? And they gave, again, the rule book changed. It changed in your favor if you know how to use it. Now, do you just go in and say, oh, okay, pay all my taxes right now? No, that's not the best way. But with our experience, with our knowledge, and with our tools, with the technologies that we employ, we're able to run anywhere between 72 and 113 different strategies, and it will find the sweet spot for your situation. So when we're building the plan and we go, okay, seek out how do we get the lowest tax bill and the biggest bang? Now, this is in combination with the investment returns, in combination with the legacy planning, in combination with
Sure.
the income needs, and it will search and scan and go boop right there. That's the one. And then we show you this is what it looks like at age 90 without a tax plan, where you and your family will end up with whatever's left over after Uncle Sam, or
Yeah.
here's the number that we're projecting under the same income, under the same inflation, everything else that you'll get with planning.
Yeah.
And that's
I mean,
value.
are you fine with just giving up 30% plus of everything you've saved and worked so hard for in retirement and dealing with that much less? That can make or break some retirements or change your comfort level in your living style and comfort level of retirement. I mean, you want to be able to retire comfortably. And I know, Bruce, you like to ask this question. You ask people, do you know what your actual effective tax rate will be in retirement? And not a guess, but the actual number based on a real plan. And I don't think people have a good grasp on that. When they think about your withdrawals from your IRA, your Social Security, if you have a pension, those types of things. In like your first year, are you gonna? Oh, we are gonna want to buy. We're purchasing a boat or an RV. How's that going to affect your taxes? I mean, these are things that people need to plan ahead for, right?
Yeah. I mean, it's I just got a new Chase credit card back. I mean, it's time, the card expired, so I got a new card.
Oh, sure.
And of course, when they send you the card, it has all this paperwork in the envelope with it.
Yep.
Here's the current interest rate, here's this, here's the minimum payment, here's all these things.
The
And
fine print.
it's not a secret. This card for me, it has a $30,000 credit limit on it. You know what my balance is? 0.
Right.
So guess what? None of that matters. So I wanna give this visual. If you're driving, listening to this on the radio, you're not seeing this in person. I wish I could do a screen share, but I'm not gonna do that. But I'll have to paint it for you. So I really want you to understand this. So if somebody comes into our office and they don't have pensions, they don't have, systematic income coming in from work. All they have is their amassed 401ks, 403bs, IRAs, tax deferred accounts, as you're saying. If that's all they have, plus Social Security, and that's going to be the engines that drive their income. We develop, plans that are 7 years, 8 years, 10 years, 12 years to to basically pay off that tax debt, divorce yourself from Uncle Sam. So I want you to picture this. Imagine when you say about those tax things and changing tax legislation and all the things that can impact you. Imagine 10 years from now that no matter what they do tax wise in the new rules, if you don't have the debt, it doesn't matter what the interest rate is. If you don't have the debt, it doesn't matter what those terms are. It's only when I'm using that card. But when I paid that card off, guess what? I'm in control. Imagine having no tax, 0 effective tax rate for the rest of your life, 0 effective tax rate for your surviving spouse, and most importantly, 0 tax rate transferring that wealth to your kids and allowing them to grow it for up to 10 years at a 0 tax rate. That's the power of elite wealth management, specifically the tax planning that we build into the retirement plans that we do for people. Whenever we say wealth management, we manage wealth. We don't manage investments. We don't only look at investments. You've done a great job. You got yourself here. you saved diligently, you planned, you did, and the planning, you did well. This isn't that you've made a mistake or something's wrong. It's saying, no, now I have my nest egg. How do I get the lifetime maximum value from it for lifestyle, for my family, for our needs, for our unplanned needs, instead of wasting it in areas that I can save money, specifically taxes.
There you go. Well, that's huge, and that's where planning comes into play. Now, what about part of the problem with a ticking tax time bomb and people taking the tax break, tax deduction now? Yep, ticking tax time bomb. The alliteration is great with the T's. Tony's talking about ticking tax time bombs. But we joke, but it's serious business because a lot of people think, well, what if I think, Bruce, and say to you, well, I don't plan on touching that money. It doesn't matter. It's in a traditional IRA. I moved it from my traditional 401k to a traditional IRA, and I'm planning on passing that money along. I've got a pension, or I got Social Security, or I got other income, or I'm just going to take a small percentage out of this account, or a lot of people have these ideas, but they're still in trouble, right? When it comes to that tax bomb, they still have a tax bomb, and why is that?
Well, it's not their problem. I mean, they've handed the bomb off. They have shipped the bomb on to their kids. It's like, okay, didn't
Sure.
blow up in my house. I don't care. I'm happy.
Well,
They
actually,
get it.
they're going to have to take care of part of the bomb before the kids get it because of RMDs, though, right?
Ladies and gentlemen, the man right here. He's got it. He knows what's going on. Right. Well, you see now you asked a question and then I was
Yeah.
kind of going, all right, so we'll get to the
Yep.
kids. Let's talk about what really happens. So with RMDs, and this is really this is one of the saddest things that I see is, early in the show you said, well, you plan for this in advance. You plan for this in advance. We do tax planning that helps people. It helps them when they're 70, 75, 80, 85. We do tax planning with 90-year-olds because of what you're talking about money passing on. We do planning with widows or widowers. Why? Because they're in a single tax bracket. Because, it comes to the realization that wherever this money is headed, wherever this money is going to be consumed, do you want that party, whether it's you and your spouse only, or your kids, do you want them to get do you want them to get the maximum amount that can be planned for? Or
Yeah.
do you want them to get what's left over without planning? And believe me, without planning is significantly less. So in the case of a spouse or even a couple that survive and live to age 90, they kick in these required distributions if you've done a good job. And you're right, people that have done well are not the people who typically spend and squander money.
Sure.
So we do see a lot of pass on type scenarios. But what happens is Uncle Sam says, "Oh no, you've got to start taking money out. Here's a percentage," and you're taking it out. And we have people that are 80 years old and find themselves receiving 90, $100,000 a year of income and being taxed on it and going, why am I paying so much in taxes? It says because you said pay taxes later, and Uncle Sam wants his pound of flesh. And if you look at the algorithm, how it works, it really works against. And then we're men, we typically die sooner than the ladies. So many times a widow is left with this account. And now that same income's coming in, but she's a single taxpayer. She's the same
Mhm.
as Skippy down at the Burger King. She pays a monster tax rate. So
Hmm.
that's the RMD triggers, and it can also double up your Medicare costs and all kinds of ugly things. But let's get to the kids. So let's say end of the line, kids are going to get the money. The prevailing attitude of most.
All right, continue. I lost you there for a second, Bruce. Technology.
Technology got us. I knew it. So people, a lot of people, the prevailing thing is, okay, let it go to the kids, and yeah, they're going to pay the taxes. I know that, but they'll get what they get. You go, okay, that's fine. Well, we build out the plan and we say, now this is what it looks like. This is how much that tax bill is, and we can show year by year what that tax bill looks like. As far as transferring over to the kids, and they're like, wait a second, what? What are you talking about? And you would think it ends there. But this is where the most devious part of retirement taxes really comes into play. Because if you live a good life and you find yourself transferring the money to the kids, how old are they going to be? Everybody talks about growth of investments till you're 90 and a big number and all that. So when you're 90 and you kick off, okay, and so let's say you had your kids when you were 30, all right? How old are they now? 60. If they had them when you were 25, they're 65. Had them when you were 22, they're 68. They're getting this money that is untaxed and must be taken out over 10 years. So let's say you pass on $1 million to one of your kids. They're 65 or 67. They're just now at the cusp of retirement. And they're going to have to take at least 100 grand a year and have it taxed, but it's also going to stack with their regular retirement income, their own planning.
So it's going to bump them up into the highest possible
They're
tax
going to be in
bracket.
this monster tax bracket, and they're going to
Yeah.
go, "What did you do to me?" You know, you may have just doubled their Medicare cost. I mean, this is not a normal conversation you hear. You'll hear it from elite wealth planners that look at multi-generational costs as we do. And if
Yeah.
you're out there listening to the show, these are questions that you should have answered. We pick up more clients that are children of our clients by bringing them into the conversation, and we get they just like, thank you, Bruce, thank you, Chris, thank you, Bruce. There's two Bruces. They get two Bruces for the price of one. But thank you for showing
Bruce.
because we never had this discussion with mom and dad.
Sure.
We're glad you did,
Yeah.
but B, I mean, you don't want to hand off this ticking time bomb to your kids, and believe me, the bomb does more damage in
Yeah.
those scenarios. And I don't want to give anybody credit inside the Beltway for coming up with this. But we're very deep in it. It's something we do, and we do very well, and have done it for decades now. We
Sure.
understand it, and it's nefarious. I mean, it's really ugly when you see this. And like I say, that right now, I think the number is 26 trillion dollars that is out there that has never had taxes paid on it. Washington is just
Wow.
loving this one. Yeah, the baby boomers are going to be the biggest contributor to government subsidy. So
Well, yeah, and why would you, as a parent, why would you think, well, my kids have to pay some taxes, so be it. I'm leaving them a lot of money. But when you actually look at it like you described, why would you want to leave money to Uncle Sam and not your kids? Why would you want Uncle Sam to have 30% of it? Why would you want to disinherit 30% of what you are leaving to your kids and give it to Uncle Sam when you can avoid it by planning ahead? And boy, I'll tell you, between the RMDs, the required minimum distributions, which can kill you in retirement. If you've saved, I've got $1 million set aside to leave to my children or my grandchildren. No, you don't. If it's in a traditional IRA or 401k, it's going to be taxed, and you're going to have to start taking money out. That IRA, you're going to have to take money out of those accounts, and Uncle Sam's going to make you. And then when you pass, he's going to tax your kids on what's left. And so that's not a good situation, and that's your tax bomb that just blew up right there in your face between RMDs and that taxation on your kids. Not good, right?
Well, this is how we explain it. When we show the planning, I said, okay, so I want to be. I said, I'm not trying to. This is not a scare tactic. Nothing. It's just factual. It's like, if you died and you go up and St. Peter said, hey, you had one piece of unfinished business you got to take care of. I know you don't want to give your kids an extra burden, so I'm going to let you go back down and take care of one thing: the taxes on your IRA. And let's say it's $1 million is where it's going to go to your kids. And let's say the check, and we see this is a very real number, ladies and gentlemen, $278,000. I need you to go back down to earth, stroke that check for $278,000. And because you say 30%, and people don't get excited about that. We try to stay away from percentages. We show you dollars and cents because that's how wealthy people talk about their money. It's how we talk about money with people. So, if you have to stroke a check for $278,000, So to hand your kids that $1 million, is that something that makes sense to you or not? And if there's a way to plan around that and reduce that check to 100 grand, to 50 grand, or to no grand, do you want to put that in place? And
Yeah.
and that's the bottom line question. We can diffuse the tax bomb. We can actually cut the wire, the timer stops, and it doesn't blow up in anybody's face. And people, they appreciate that efficiency. Does everybody say yes, that's what I want? No. We have people that are like, I don't care. I don't care. I worked hard for it. Let them deal with it. Okay, that's fine. There's still other planning areas where we help people. Yeah, we have
Right.
people that are clients of ours that are saying, I don't want to do all that. But and there's lots of advanced strategies. We just had a big case with a client who, we put the tax plan together, and they said, okay. And I have to give them credit because they actually saw this and came up with it on their own. We didn't suggest this. They said, okay, we're going to save, I think it was $480,000 in taxes projected over our lifetime. And they said, we're only going to live for the next 30 years, in your scenario. And that's probably realistic. So if I bought a life insurance policy for the cost of the taxes we're paying, and it's $10,000 a year, and it's going to cough up that money at the end of the term, you know, will that work? And we said, well, that'll work, but it also can do something else. What if we make that death benefit accessible for long-term care so it doesn't deplete? You can use the death benefit while you're alive if you or your wife need home care or whatever the case may be. And he's like, whoa, 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 you can do that? And I'm like, yeah, we can shop it out. We basically go out and get bids. We're not Prudential or New York Life. We go out as a high-end advisor and get competitive quotes. So there's lots of strategies here, ladies and gentlemen. It's not just how you beat the tax man, it's how do you get the maximum lifetime value from your accumulated retirement wealth. If
Yeah.
that's your goal, and I find that's the common goal of everybody we work with, if that's your goal, and you're not going to achieve that if all you have is a portfolio manager or a portfolio management program. So if you want that level, that elite wealth level of planning, pick up the phone and call us 888-888-5601, or visit us online at wealthcare with a K.com. You want to know more about us? Why, or ask wealthcare.com with a K.
Yeah.
And we'd love to have that 20-minute discovery call to start the conversation and see if there are opportunities that fit you and your family.
All right. Well, let's just a little bit here before the end talk about what we've covered and what people can do. You're talking about that discovery call. I love that. But a lot of people are thinking, well, why doesn't everybody then just put all their money into a Roth IRA? That's not realistic, is it? And there are so many rules that doesn't a Roth isn't necessarily the right thing for everybody, is it?
Well, first of all, there are contribution limits.
Yeah.
Okay. Now, with Secure Act 2.0, they did open the door, and we now have, for most plans out there, your plan at work, it probably allows you to contribute your 401k contribution into a Roth inside of your 401k. They did open the door, and it allows employers to also contribute their share, though most employers have chosen not to open that door yet. So the employer share still goes into a traditional tax deferred portion. The other portion, you have a choice. You can pay the tax now or pay the tax later by using a Roth option within your 401. Again, you're subject to the limitations of it. So people who have amassed monies in these tax deferred accounts over their lifetime, nobody turning 60 today who's been contributing since they were 20 ever had the ability to put it all in a Roth during their working years. That only came into vogue recently. So that's what we're seeing. So now it's basically what's the best path forward, to minimize that. And it's great that they opened the door. I'm personally, to this day, I'm still shocked. I mean, they took a very noble idea of the Roth, which again was designed for low income people to have a retirement plan of some kind with no adverse taxation, but then to just blow the doors open and say, hey, this is probably the best retirement planning opportunity in history. And I can't stress that enough. In history, more valuable, more important than your investment planning.
Yeah.
And the people love this balance. It's like if I can find a couple $100,000 extra money on the tax savings, I don't have to take as much risk over here, and I can have a very well-rounded, more efficient, more durable plan. That's what I love about what we do at WealthKare. Yeah.
Yeah. I think that's huge, Bruce. And you do need to be aware of these things. And there are so many rules. The rules around Roths and how they work and your 401k or your TSP, whatever you have, they're constantly changing. It seems like people are like, okay, I got the pieces in front of me, but they keep moving back to the puzzle analogy. It's like, oh, I've got that piece that fits there, right? Wait, where did it go? IRS or the government, somebody moved it because a law changed or something from the Secure Act 2.0 went into effect in 2026 and changed the way we plan, right? And especially when you're talking about elite wealth planning, it really is important to have somebody that's a professional that's on top of these things and has already can plan for that, and reviewing where you're at, especially before you get into retirement, making some of these moves and tax planning decisions as early as possible. It makes all the difference, right?
Yeah, I mean, I'll give you a really crazy analogy. And anybody who knew me back when I was a teenager, but a teenager. I mean, I never had the greatest car, but I always worked on my own cars and put big motors in them and big tires and all the
Oh
craziness.
yeah.
But I'll give you so this is the importance of knowing what's in the rule book, okay? Is I got pulled over one time for an expired inspection sticker, and it was pricey. Today, it's a couple $100, and but interestingly, if you read the rule, it says if you have an expired sticker, it's almost $200. If the vehicle has no inspection, it's $40.
Hmm.
So if I found out, oh, my sticker is expired, I scraped it off. It's like if they pull me over and go, hey, you don't have an inspection sticker, $40 fine. I'll take that until I get it inspected instead of having an expired sticker. You can call it a loophole, you can call it what you want, but knowing the rules, knowing what's possible, knowing what the costs are, that's how powerful it is. And it's all around us.
Yeah, it is.
So yeah.
It is. Well, Bruce, this has been a great discussion. But now, before we leave, let's plug the great resource and all the videos you've put together on so many topics that people can look through, and then they can schedule that consultation. How can our listeners do that? Where should they go?
So the best place is start with why, WHY, why WealthKare? Why do I want to talk to these people? Why do I want to listen to them? You're listening to the show. You started somewhere good. So why WealthKare, the word why, WHY, WealthKare with a K.com. If you look for the questions people are asking about retirement, ask wealthcare.com is our second site. And if you can't remember either of those or you're driving, just when you get home, go to WealthKare, wealth like money, KARE.com. And at the top right corner, look for the little red bracket. You can go there and you can basically binge watch. You can see all the videos. They're all under 2 minutes. They're easy peasy. We're actually got a couple emails last week from spouses that surprised me quite. Hey, my husband listens to your show going to work, and hey, I watched a couple of your videos. Hey, thanks a lot for that. We had one that says, my husband doesn't involve me in this stuff, but he said these videos were pretty good, so I've been watching them. And I'm like, wow, it's working. So we want to educate you. That's why we do the show. It's why we do the videos, and we're always going to be there for you. So
yeah, that's awesome. Well, I'll tell you what, great show today, Bruce. Listeners and viewers, thank you so much for tuning in. We covered it, the ticking tax time bomb. Boom. Right? All right. Thanks, Bruce. Listeners and viewers, thanks once again for tuning in. That does it for today's episode of Unlock Your Retirement with our host, Bruce Smith.
Have a great week, everybody.